Now let us learn about the first model or first theory under dividend theories, which is known as Modigilani and Miller or MM hypothesis or MM theory. Now this theory is also known as dividend irrelevance theory. Irrelevance theory. So as the name suggests, what does this theory states? This theory concludes that the payment of dividend, I can say payment or non-payment or the proportion of dividend paid, does not affect the value of the firm. So the value of the firm remains constant. It remains constant irrespective of the dividend decision or dividend payment. Dividend decision or dividend payment. So whatever be the dividend that you are paying, your value of the firm is not dependent on that. That is what this theory says. Now when you come to this theory, there are certain assumptions. Okay, in other words, only if these assumptions are holding good, this theory will be valid. Okay, so let's see what are those assumptions. The first one, this method presumes or assumes perfect capital markets. Okay, and what do you mean by this perfect capital market? Perfect capital market is a market in which all investors are rational and information is freely available to all. What does it mean? It means that whoever be the investors who are available in the market, they have access to free and fair information. So there is no situation where a group has has access to certain information while others doesn't have that access. Everybody has information to all news, all information. So the decisions are taken by everyone freely without any bias. That is assumption number one. Now let me tell you friends, this assumption will not hold good in any of the market. If you see, there will be certain group of people who will have an easy or early access of information. Okay, so that is the first assumption. Now coming to the second assumption, there are no taxes. Okay, there are no taxes. And what is the implication of these taxes? Since there is no taxes, an investor is not concerned about dividend income or capital gain appreciation. Okay, so if there is dividend, there is no tax. If there is capital gain or capital appreciation in the stock, there also there is no tax. So since there is no tax, both the investor is indifferent between dividend income or capital appreciation. So that is the second assumption. The third is fixed investment policy. That means what does it mean, fixed investment policy? It means that it means that the entire investment that the entity is proposing to make is financed only through equity and there is no debt. Okay, so there is no debt. Whatever money is required for financing a project or for financing a particular activity, okay, or capital budgeting decision, it will be raised only in the form of equity. Okay, and when you talk about it is financed in the form of equity, the equity could be by way of fresh equity raised or maybe by way of retained earnings. So whatever be the method, whether it is retained earnings or additional equity, it is equity only. Okay, or equity, it is equity capital only. No debt component is utilized in that. The last one, there is no flotation cost or transaction cost. Flotation cost refers to the cost that is incurred by the entity while raising new debt. And this theory says that whenever an entity raises any additional equity, there is no such cost or there is no flotation cost. That is the second last assumption. And the last assumption, the risk of uncertainty does not exist. What does it mean? The investors are able to forecast the future prices and the dividend with certainty, and the discount rate is appropriate for all securities and all time periods. So there is no uncertainty with respect to the payment of dividend in future. because the investors know that this company will pay this much dividend at the end of first year, second year, like that. There is no uncertainty. And even for discounting purposes, KE we use cost of equity. Okay, for discounting purposes also, the discounting factor is common or constant for all the information. So there are no variation in this. That is the another assumption. Okay, now coming to the theory. Okay, this theory, okay, we are talking about Modigilani Miller theory. Modigilani Miller theory. Okay, this theory is used for evaluating or for determining, okay, for determining the value of the firm. Okay, so it is used for determining the value of the firm. And for a firm which has got n number of equity shares, okay, let's suppose there is a company and the company has got 10,000 equity shares. Now the number of equity shares, that is 10,000, is what is referred as n. Okay, and we know what is P0. P0 is the value per equity share at present, or T0. Okay, so value of firm NP0. What is NP0? N is the number of shares, P0 is the value per share. So NP0 is N into P0, that is total value of, this is number of equity shares into value per share. And what is this formula? This formula is equal to, okay, this formula is equal to N plus delta N into P1 minus I plus E divided by 1 plus K. Okay, it's a beautiful formula. Okay, let's see how this formula is derived. Okay, so this is the formula. Now we are going to learn about derivation of this formula. Okay, now we have already learned about, okay, one formula called P0 is equal to, what is P0? P0 is the value of the company as on today, value of the company as on today, or value of the firm as on today. Okay, so P0 is equal to, okay, P1 plus D1 divided by 1 plus K. What is this formula? What is this P1 plus D1? P1 is the price per share at year 1 ends. And what is D1? D1 is the dividend per share at year 1 ends. So whatever be the value that the shareholders get at the end of year 1. Okay, suppose you are holding one equity share. Okay, if you are holding one equity share at year 1 end, you would have received dividend of D1, plus you will be having one share with you which has got a value of P1. So the total value what you have is D1 plus P1. I hope this is clear. Okay, if you are a shareholder and you are holding one share of the company, you would have received dividend which is equivalent to D1. Okay, plus you are holding one share at the end of year 1. So the value of that one share is P1. So the total wealth what you are having in your hand is nothing but D1 plus P1. Okay, and this D1 plus P1 has been received or has been originated from what? It has originated from P0 only. P0 means what? P0 is the value per share at the beginning of the year. So let's say this is on 1/4/2022. On 1/4/2022, you purchased a share by paying 100 rupees. Okay, 100 per share. So this is P0. Now this should be equal to, okay, this 100 per share which you have purchased today, okay, or the share which you have purchased today will give you D1 plus it will give you P1, which is the value of share. Now let's say you received a dividend of 10 rupee from this at the end of first year, plus one share is having a value of, let's say, 115 rupee. Okay, so this is at T0 and this is at T1. Now if you want to equate, what do you have to do? You can also write, okay, 100 into 1 minus 1 plus KE. 100 is the present value, that is P0. P0, when you compound it, what you get? You get the future value. So this is the future value of one share. Future value of one share. This is equal to what? D1 plus P1, because P1 is the future value per share plus you have D1 with you. I hope this is clear. So if you use this formula, I can write this formula as, okay, P0 into 1 plus KE is equal to D1 plus P1, or P0 is equal to D1 plus P1 divided by 1 plus KE. Okay, so this is the formula. Now what is happening here? Now I am going to do certain calculations with this. Okay, what are the calculations we are doing? Okay, with this I am going to multiply both sides with what? With n. Okay, n is the number of shares. N is the number of shares. So if you multiply it with the n, then what it will be? It will be np0 is equal to n into, okay, d1 plus p1 divided by 1 plus ke. That is equal to n d1 plus n p1 divided by 1 plus k. Okay, now what I am going to do? I am going to add and subtract. I am going to add and subtract one value from this numerator. See, with this numerator, if you add, let's say 100 you are adding and you are minusing the same 100, will it make any change? No, it will not make any change. So similar way, I am going to add a constant value. Okay, what is that constant value? The constant value is delta n p1. Okay, so I am going to add this. So while modifying the formula, it will be np0 is equal to nd1 plus np1 plus delta np1 minus delta np1, okay, divided by 1 plus ke. Now you might ask me, what is delta npi? Okay, delta n is the number of shares to be issued to finance new project. So it is like you want to finance a project, you want some money to do a project, and for getting that money you have to issue some shares or you have to use your retained earnings, whatever be the case. Okay, delta n refers to the number of equity shares that you have to issue to raise further funds for financing your project. Okay, and P1 is the price per share at the end of year 1, and this delta n, the number of additional shares which you are issuing, that is also being issued at the end of year 1. So delta n into P1 is nothing but the total value that you receive by issuing the number of shares, delta n. Okay, now if you use this, okay, how it will be like? It will be like, so this is the formula. Now if you see another formula, okay, the retained earnings, okay, retained earnings is equal to, okay, retained earnings is equal to total earnings minus dividend paid. So what is total earnings? Total earnings is N, E minus dividend paid will be N number of shares into D1, N D1, N into D1. Okay, so retained earnings is equal to E minus N into D1. Now what is next? Suppose, okay, suppose you require amount required, okay, amount required for financing the new project. Let it be I. So I be the amount required for financing the new project. So I. Now how can you raise this I? I can be raised either by way of new equity or by way of what? Retained earnings. Because in the assumption we say that there is no debt, retained earnings. So new equity to be raised is equal to, what is new equity to be raised? New equity to be raised is I is the total fund required minus retained earnings, because whatever retained earnings you are available, that much fund you don't have to raise extra. If you need 2 lakh rupees for financing your project and you already have a retained earnings of 1 lakh, only the balance 1 lakh you need to raise additionally by issuing equity shares. Okay, so this I minus retained earnings, or that is equal to I minus E minus N D1. Okay, so if you see the formula, okay, you have, this is the new equity to be raised. Okay, now if this is the case, okay, number of shares to be issued, number of shares to be issued is nothing but delta n. So delta n is equal to, okay, it is new equity to be raised divided by price per share at the end of year 1. Year 1 and what is the price? That. So that is equal to, what is new equity to be raised? We have already computed. I minus, okay, I minus E minus ND1 divided by P1. Okay, so this is nothing but delta N P1 is equal to I minus E minus ND1. Okay, so this is another formula. Now if you see this formula which we have already computed, this formula has delta N P1. Now delta N P1, we have a formula over here, so substitute that. Okay, so therefore np0 is equal to, okay, np0 is equal to nd1 plus np1, okay, np1, okay, plus delta np1 minus what, minus I minus E, okay, minus nd1, that is equal to nd1 plus np1 plus delta np1 minus I minus of minus will be plus E, okay, then minus of minus, that is minus nd1. Now if you see, whatever gets cancelled, this and this get cancelled, so that is equal to np1 plus delta np1 minus I plus E, and this p1 is common factor, so it will be n plus delta n into p1 minus I plus k plus E, okay, and we forgot to take this 1 plus ke, so take that also, so this divided by 1 plus ke, this is also divided by 1 plus ke, okay, this is 1 plus ke, so this is also 1 plus ke. So in nutshell, the formula will be, what is the formula? The formula will be np0 is equal to n plus delta n into p1 minus I plus E divided by 1 plus ke. And what is n? N is the number of shares, okay, p0 is value per share, so np0 is the value of the firm today, okay. Now delta n is the number of equity shares to be issued, okay, number of equity shares to be issued, then that is equal to I minus E minus nd1 divided by p1, okay. And what is p1? P1 is the price per share after year 1. p0 is the value per share now or at present, this is the future value at year 1. Now I is the investment required again at year 1. Then E, what is E? E is the earnings, for the year. And now, since when you have this formula, okay, np0 is equal to n plus delta n into p1 minus I plus E divided by 1 plus ke. Now my question is, if you see this formula, why is it known as dividend irrelevance model? Why is it known as dividend irrelevance model? Now the answer to this is, if you see this formula, in none of this formula there is a mention about dividend payout. So in this formula, the value of firm is not dependent on the dividend paid. So there is no mention about any dividend paid in this formula. That is why this method or this hypothesis says that the value of the firm is not dependent on the dividend policy that the company or the firm follows. I hope this is clear. So once you have a question on this, what do you have to do? You have to find out the value of the firm using this formula, and once you have found out the value of the firm, you have to substantiate that the value of the firm is not dependent on the dividend payout. Okay, so in the question they will ask you, okay, if there is no dividend paid, what is the value? If the dividend is paid, what is the value? If the dividend is paid at a lower amount, what is the value? In all the cases, the value of the firm should not change. Then this hypothesis or this theory will hold good. Okay, so this is all about Modigilani and Miller theory for dividend irrelevance model. Okay, now we will do a couple of problems from this model.